many of the companies of Kerim and Souk and etc., it was a scale at all costs. I mean, scale was the name of the game. I remember that to be a MENA startup, you had to be in every geography in the region, even if it was loss-making, because the goal was numbers, numbers, numbers. In the last 3-4 years, because of the contraction of capital relative to interest rates being at 0% in 2020, 2021, people have moved towards profitability. But I think this is a maturity of the market rather than it being a problem.
Philip Bahoshy is the founder and CEO of MAGNiTT. It is the leading venture capital, data and intelligence platform covering the Middle East, Africa, Pakistan, Turkey, and even other emerging markets.
If you remember, and we go back to the success of the Kerim acquisition by Uber, the FOMO that was created in the ecosystem from the private sector, who were given the opportunity to invest and maybe did not participate, led to a new generation of funds being created, people investing as LPs and GPs, and governments having stronger confidence to continue to double down.
You're saying $1.3 billion of investments in MENA venture capital. That number, I assume, with respect to global venture, probably is extremely low. It's like a rounding error. Why is it so low?
VC in general is always, in any geography, going to be an interesting game. Each one has LPs. Each one has targets that they need to invest in. They have a return that they need to justify for LPs themselves. And so it is a difficult business with very high benchmarks that they need to try and meet. But founders have to find capital wherever they can find capital to continue to grow their businesses.
There is a concern that in the last 10 years, the M&A coming in or the players entering the market was mostly coming in from the West. But currently the wave coming in is coming in from China, whether it's basically Kita, whether it's ByteDance, whether it's Shein, etc. And Chinese companies in general, they tend not to acquire, they tend to come in organically. So that actually creates a risk of even less M&A going forward and just companies organically losing market share to these very aggressive Chinese entrants. So how do you see that?
If you're a vendor and you're a supplier and you're a corporate, don't delay payments. If there's one thing that you can do to support founders at this point in time, pay on time with transparency. Nothing kills companies than cash flow. And during this time, being able to be transparent on payments is more powerful than any funding.
Assalamu alaikum and welcome to The Mal Show. You know how the venture capital industry ultimately runs on stories? Some big funding rounds, some unicorn headlines, billion-dollar valuations. But beneath these headlines is a much more important question. What is the data actually saying? And that's why today our guest has spent the last decade trying to answer this specific question. Philip Bahoshy is the founder and CEO of MAGNiTT. It is the leading venture capital, data and intelligence platform covering the Middle East, Africa, Pakistan, Turkey, and even other emerging markets. You know how today governments, sovereign funds, venture capital firms, corporates, and founders are trying to access the latest data. They rely on MAGNiTT to understand where the money is flowing, which markets are growing, and what the numbers are really saying. In this episode, we'll go well beyond the funding headlines. We'll dive deep into whether MENA venture capital is really stronger than it looks or actually weaker than investors admit. Why early stage activity matters more than billion-dollar rounds and headlines. Whether exits are finally delivering real returns, how these latest geopolitical events are reshaping private markets, and what LPs are actually demanding. And finally, what needs to happen before venture capital becomes a true asset class across the region that everyone can take seriously. If you're building startups, investing in technology, allocating capital, or even if you simply want to understand where the future of the business in the Middle East is heading, this conversation is definitely for you. This is The Mal Show. Don't forget to subscribe to get the latest episodes. Let's begin. Philip, thank you so much for joining us.
Thank you, and very congrats on the podcast.
Thank you so much. I think it's a great timing because the MAGNiTT H1 report just came out. Tell us, what are the key takeaways?
I mean, look, that's a big question. So MAGNiTT's been publishing reports for about 10 years, and every 6 months, every quarter, we're publishing the insights. The high-level numbers, 1.3 billion of investments have been recorded in the first 6 months of this year. The headline would be that it's down from last year. But the truth is, and I think you appreciate this, let's just take a step back. Global venture capital, so CB Insights just published their H1 report, has seen declining transactions since the peak of 2021. So total number of transactions globally has seen literally a straight line decline. Capital has been increasing. Why? AI, defense, infrastructure. So a lot of capital has been going into those global thematics that have become the hotbed, both in the public sector and in the private sector. So investors have globally been doing much bigger bets in a smaller number of transactions. The region is not immune to that. In fact, we noted that there's been a declining number of transactions since what we call as a bit of a peak last year, which we can deep dive into. And Q1 and Q2 saw declining transactions across the MENA region. But capital in both Q1 and Q2 remained almost flat between 650 million in both of the quarters. But there's a lot that underlies that. Mega deal investments, late stage, big rounds have been the largest contributor. And actually, Q2 saw the lowest number of transactions dating back all the way to 2022. So we're in an interesting time globally and regionally. And I'll stop before kind of following on. Many people are interested to know, how has the geopolitics impacted venture? My simple answer is, it's not absolutely clear. Because as you would know, given your background, any deal that is announced, signed, is likely to be 6-9 months of fundraising, conversations with investors. And that data, in my opinion, given that the war really only onset in March and April, is likely to reflect in the Q3 and Q4 data, albeit there are early indicator and signs that international appetite has kind of slowed down, early stage investment has slowed down. So there are early indications in the Q3 data, but the true reflection is likely to come in the next couple of quarters.
So I think let's break this down. I think first of all, you're saying $1.3 billion of investment in MENA venture capital. That number, I assume, with respect to global venture, probably is extremely low. It's like rounding it. Why is it so low?
Well, I mean, you can argue how's it grown? I mean, that number 3-4 years ago was 500, 600, 700 million, right? So there has been a continued growth in venture in the region. If you take venture as an asset class, if you go back to 2013 and 14, venture capital wasn't really an asset class that existed here in the region. The WAMDAs, the MEVPs, the Bico Capitals, which were the forerunners of the venture ecosystem here, were founded during that period. A typical fund is about 8-9 years in terms of their kind of deployment, if not 5 years sooner. And it was really thanks to the likes of Fadi, the celebration of entrepreneurship, the drive from the government that started in the UAE to diversify away from oil. And then Saudi, which was in 2018 and 19, started to focus on venture and asset class, that you saw the development of the fund-of-fund structures, whether it was the Al-Waha fund, the fund which was first in Bahrain, followed by ones that you saw here between Mubadala, Dubai Future District Fund, and in Saudi, specifically the likes of Jeddah and SVC, Sanabil, and you have ISSF and some that exist in Egypt. Those were the fund of funds that spearheaded venture as an asset class. And to be fair, and I've had a lot of conversations now with key stakeholders understanding what's happening, it's a double-sided marketplace. You've got the LP side, but you also need to have a constant flow of companies that are able to grow from seed to Series A to Series B and Series C. And those need to be nourished from a policy, from an ecosystem perspective, from founders that are comfortable starting companies. And so there has been continued growth, specifically in the GCC, which is where the capital has tended to center, in the last 4 to 5 years of capital growth. However, what it looks like in terms of the percentage of GDP, I think off the top of my head, because it's a great question, 0.2% of GDP is the equivalent of venture capital, whereas in the US it's 1%, and in Singapore, which is always an interesting benchmark, is around 2.2%. So we are far lower than international benchmarks in terms of venture, but both the supply side of capital and the demand side has to continue to grow. And let's just call a spade, and I'll stop in a second. The last 5 years have been extremely turbulent, whether it was COVID, coming out of COVID, the geopolitical situation that exists here in the region. Companies need to scale and grow, and that's been one of the challenges that the region has faced in terms of capital capture and deployment.
So let's start with the supply side. As you said, a lot of it has been a government drive. And probably if you look at underlying these VCs, probably the majority of the capital is coming between government, fund of funds, pension funds, quasi-sovereign type entities. Is that a scalable form, or is that just kind of a government trying to create an ecosystem and trying to create the right narratives, but then that can only really scale once private sector money comes in? And why is that private sector money not coming in a meaningful way?
So, I mean, great question. And there's two parts. Why is the private sector not coming in a meaningful way? You will know this better than I, that success drives success. And venture is not a charity. It is an asset class for which you are competing against the stock markets, which are all at record highs, fixed income, corporate, real estate. And therefore, to justify further investment in that asset class, we need to see success. And success comes from M&As, and it comes from IPOs, and to a certain extent, secondaries. If you remember, and we go back to the success of the Careem acquisition by Uber, the FOMO that was created in the ecosystem from the private sector, who were given the opportunity to invest and maybe did not participate, led to a new generation of funds being created, people investing as LPs and GPs, and governments having stronger confidence to continue to double down. However, in the last couple of years, there has been a lack of meaningful exits. Not to say that there haven't been. One area that's extremely difficult to discuss is kind of the secondary transactions because they're not well documented. It's one of my personal challenges for the next 6 months to kind of identify. But in terms of M&As, which again, we brought out a report on this, less than 7.5% of all companies that have raised funds have seen an M&A transaction. And I can't speak to the quality of those M&A transactions because some of them end up being fire sales. They end up being kind of consolidation within markets. But a couple of stats that are also interesting for this point in time. 25% of the acquisitions that have taken place in the last 10 years have been international acquirers of regional companies. Are those international companies still interested in the region in the next 2 to 3 years? And what needs to be done to support and encourage that M&A transactions? 50% of all the companies that made acquisitions were larger tech companies acquiring smaller tech companies. Well, given the geopolitics, given the economics of the region, are those companies focusing on their own businesses as opposed to trying to do inorganic growth? And therefore you start coming, and this is an orange flag that I raised at the beginning of the year, that for the turn wheel to kick in, for governments to continue to justify investment, for LP funding to come from the private sector, you have to see these successes. And unfortunately, now we have to be in a patient wait and see holding period. But the governments also need to acknowledge that they need to continue to double down in that asset class, because the Middle East is not necessarily like the US. If you look at the LPs, number one, generations of evolutions, we are now entering that second decade. Well, US, European venture, which I don't like to benchmark against, but have been 40, 50, 60 years in the making. LPs are endowment funds, pension funds, multi-defense sector LP recognition, corporates that invest in that pace, big family institutions that are investing in that asset class because they've been attracted by the returns. And therefore, in the absence of that, where is that LP money coming from? What incentives could be put in place to have a greater corporate participation, either as LPs or direct investors? What can be done to offset family offices' risks by investing as LPs into regional funds? And the flip side of that is, how can more of the VCs sell a story through data and insights on the successes of their funds, as well as the challenges that they faced, that can encourage further investment moving forwards?
So I think one side of the challenge, as you said, is venture specific. However, if you look at another side of it, even if you go outside venture, if you look at, for example, private equity in the region,
Yes.
you have a very limited number of funds and capital because most investors would rather do deal by deal deals. And that's why the success of InvestCorp, for example, is compared to like blind pools. And that problem extends to venture. So how can this kind of concern from people and from LPs and family office around blind pools, how can that be addressed?
I think it's conversation. It's I mean, obviously selfishly we're a data company, but like data facts are able to solve many problems by one, the best way to solve a problem is to identify the problem. So sometimes it's important to identify the problem. And there tends to be an environment where these are closed door conversations that happened in meetings, but actually if you want to solve for them, there needs to be a platform that allows for people to share the challenges as well as the opportunities that can be addressed. Second is I think that it's not just about capital. It's unlocking capital from private institutions. So when you understand those family offices' concerns, and let's call a spade again. Right now, I think that the AI explosion that's taking place in the US and China is attracting a lot of local money, as it has always done traditionally. Like for like, if you have $1, where are you going to spend it? Into a Silicon Valley fund or a Silicon Valley startup or into a regional startup? And therefore, it's a difficult environment where everyone's racing for the next OpenAI, Anthropic, etc. So I think to a certain extent, both LP money at a government level and a family office LP funding perspective is being sucked into that sector globally because that's where they believe the next opportunities come from. And then on the second side is how can we have a more meaningful and constructive conversation with key players at a country level or a regional level, given some of the sensitivities, but at least at a country level, that can offset some of the challenges that these family offices are facing to encourage them with a medium to long-term horizon to invest in this asset class. But it'll come through the data. What are the success stories? What are the success stories that we may not have identified because they didn't have big IPOs, but maybe coming up to IPOs? What are the challenges that they're facing? What are the challenges that the founders are facing to be able to scale given the current environment? And I think I've always said that as we get into the second decade, we need to be comfortable a bit more with the uncomfortable truths to be able to solve them so that the market can continue to evolve.
Now, let's go back to the exits point. So let's start with the secondaries. So actually, some of the biggest success cases in the region have been in secondaries, like the Impact 46, Jahez, etc. Yet secondaries remains a very small part of the overall equation, and you only have maybe now one fund, which is Key Capital, which is exclusively focused on secondaries. So why is it, despite the success of secondaries, remained very limited and is not really taking off in a large way?
Look, it's a great question. I've started discovering, thanks to Basil, who's a good friend, but a big proponent of the secondary space, what secondaries are. So I think that we sat the other day and we will be putting out some research in the next 2 to 3 months on what we estimate is actually the size of the secondary market. And when you start seeing big investment rounds, MAGNiTT has a lot of data. So if you know that an average Series A investment round, for the sake of argument, is about 12 million, but a Series A investment is announced at 50 million, you can safely say that something is outside of the standard deviation. And so it's either venture debt, because they've raised debt, and you can go through and ask the investors whether debt was part of it, or you can assume, especially at a Series A or Series B and Series C, more so than at seed, that there was potentially a secondary proportion of that investment round. So as of today, I can't tell you the size of that market, but I wouldn't be surprised that if up to 30% of investment, and that's just a prediction, was secondary transactions. So even the amount of primary capital is smaller than we've currently been anticipated. Why is it that we don't speak about it? Well, because in the end, secondaries are to give liquidity back to early stage investors. It's not publicly announced. It's not an M&A. It's an exchange of money from one investor to the other. It's not injection of capital. It's share transfer. Some of the founders sometimes take the opportunity. So maybe there's a stigma around them taking liquidity in an investment round. And we don't have regulatory bodies by which we pull this information. I mean, ultimately, MAGNiTT exists because we don't have regulatory institutions at a BVI, Cayman Island investment vehicle level where there is full transparency. And so we are using all of our market intelligence and data to be able to proxy this. But in the absence of that, people aren't sharing and disclosing it. So I think that the question mark is, why are people uncomfortable sharing this information? And I think that's a psychological question that needs to be discussed with VCs. And then as a result of that, can we quantify that to see what the market opportunity exists? So I think your point about Basel being potentially one of the few funds, true, but it doesn't mean that secondary transactions aren't happening. They're clearly happening at every level of the evolution of the investment funds, but it tends to be a cleaning of the cap table as companies raise funds at later rounds.
You mentioned some of the rounds which look larger than expected. So one reason can be secondaries. One other reason I think was also happening is some of the founders are also frustrated a little bit by the VCs in the region, their pace, their ability to build conviction, and hence are potentially seeking alternative sources of capital, which may come from corporates, from quasi-sovereigns, from specific strategics. And we've seen, for example, we've had on the show Abdullah Abu Sheikh, the founder of MAL, who's raised one of the rounds which are disproportionately larger. And he's written a piece recently about, again, his frustration with the VC side of things and how he seeks some of the alternative sources, which we're seeing more. So how do you see this balance between VC funding the region, let's call it alternative sources and structure of deals, and how do you see that landscape?
Yeah, look, I mean, and it's clearly a developing landscape that we're seeing now. If you look at the H1 data, Blue 5 Capital have made 3 large investments. MAL, thanks to Mal for the show, but one of them is in Mal, Cargo X, AI, and other such transactions. They are different. They're disrupting the way that traditional VC has been done. What's interesting about at least 2 of them, they're second-time founders. So there is a maturity in the market that there are newer, recurring founders who have experience in fundraising that may be able to attract newer capital than before because of their track records. And I think that in general, the market can embrace all types of capital for it to continue to grow. Not just that, we're seeing more credit happening. We're seeing more venture debt happening. But again, those are more mature companies. Companies have been forced, I mean, at the time, I'm sure Growing Swivel and many of the companies of Kareem and Souk and etc., it was a scale at all costs. I mean, scale was the name of the game. I remember that to be a MENA startup, you had to be in every geography in the region, even if it was loss-making, because the goal was numbers, numbers, numbers. In the last 3-4 years, because of the contraction of capital relative to interest rates being at 0% in 2020, 2021, people have moved towards profitability. And as these companies move towards profitability, new opportunities for capital allocation, whether it's lines of credit, people are obsessed with private credit right now, venture debt as an alternative asset class, corporates as strategics, which come with challenges because naturally strategic monies can have incentives for the corporates, which can be a challenge for venture because clearly they want to have exponential growth that comes from international investment rounds. But I think this is a maturity of the market rather than it being a problem. But I don't want to speak about the behavior of the existing VCs. VC in general is always, in any geography, going to be an interesting game. Each one has LPs. Each one has targets that they need to invest in. They have a return that they need to justify for LPs themselves. And so it is a difficult business with very high benchmarks that they need to try and meet. But founders have to find capital wherever they can find capital to continue to grow their businesses.
And on these high benchmarks, right, sometimes there's a point of view that says if you look at the underlying returns of the VCs to date in the Middle East, and you've touched upon this because of the challenging environment we have, especially compared to more liquid asset classes like real estate and like public stocks, there just hasn't been that incremental return that justifies the illiquidity and the longer horizon and risk involved.
Yes, absolutely. But I mean, again, it's been a really challenging 5 years. I keep telling the team, I mean, like, I believe it's amazing how quickly people forget. Again, I don't want to go into geopolitics. I don't want to go into COVID. I don't want to go into all of the economy. But people are forgetting that there have been challenges in the last 4 or 5 years. COVID was something that shocked the ecosystem. Interest rates went down to 0%. Funding was being going left, right, and center. Inflation grew. Interest rates went up to 5%. Investment contracted. Companies had to change their business models. People started coming out of that. There was a heyday in the region. Everyone's coming to the region to raise capital because sovereigns in the region were deploying capital. In the last year and a half, some countries are cutting their budgets and having to rebalance their books. Then there's a lack of funding in the ecosystem. DPI, MOIC, TVPI, many of these metrics, which are VC-specific metrics, are also driven by success stories. And those success stories, even with a portfolio theory of like 20% of the portfolio paying off the 80%, are not unrealized gains. They need to be realized gains. And that goes back to, as I mentioned, the exits. And we discussed, because I shared with you, I thought it'd be interesting, MAGNiTT created an MGTI index. We tried to create a public market index of tech companies in the region. Why? Because we tried to understand, okay, once these companies have gone public, how have they performed? Because there seems to be this theory that IPOs are going to be the silver bullet that's going to solve for all of this because they become realized gains. Well, the reality is that they have underperformed. We have 15 companies, and again, it's not many. It's interesting that none of them are featured in global emerging market benchmarks for tech. But we have the likes of Talabat, we have the likes of Rami's in there, we have Jahiz, Rasin. The index is flat year to date. So where the NASDAQ is at record highs, all emerging market indices for tech are, because of the AI boom, etc., the regional tech index, which was launched or updated last week, is year to date flat, down 17%, up 20% in Q2, impact of the war, follow up on the war. So even when they go to the public markets, and we're seeing Anthropic coming up, we're seeing OpenAI, we saw SpaceX, all these massive windows, the exit opportunities are a challenge. Now, I do think that there are solutions for them, or at least a path towards that. Companies need to think global. We can't purely think regional. And I think AI is going to really help that. There is something that can be done to roadshow many of these companies to the public, the international market. That 24% number is likely to continue to grow if you see more and more international acquirers interested in what's happening here in the region. And governments, for where many of these companies are already doing roadshows, many of them are going to international markets, but almost using the foreign relations as an opportunity for these companies to build presence in foreign markets headquartered from the region. Corporates, we go back to corporates. Corporates should be bigger acquirers and or investors. We published with STC a report on corporate venture capital here in the MENA region. 12% of all capital deployed into venture is coming from corporates. A conservative estimate internationally from another publication is it should be closer to 18 to 20%. And I believe it could be bigger, but why should they get involved? How should they get involved? And we see incubators and accelerators and different things being set up, but it has to become more meaningful. So to your point, yes, when it comes to the DPI calculation and the return of those funds, exits will lead to, and it either comes from secondaries, M&A, or IPOs. And each of them have different opportunities with challenges. And it goes back to the question you asked me earlier. We need to all be comfortable identifying the challenges so that we can start finding in the next decade of the evolution of the market, the solutions that can unlock these opportunities.
So you talked about the challenges that the 15 companies which are already listed, let's say, are facing and the returns. If we take a step back, why are they 15 companies only in the first place? And one of the main reasons is still the regulatory framework, which does not allow pre-profitability companies in the vast majority of exchanges across the region to list.
Yes.
Do you see there is an opportunity for that to change? How do you see that? Because that will remain a main inhibitor that constantly delaying the listing of tech companies.
Yeah, so we identified, I think, close to 50 companies that were technology-related businesses who had listed in either the MENA exchange and or the NASDAQ coming headquartered from the region. And then we followed a methodology of MSCI and looked at each of the different metrics. Did they meet the geographical benchmark? The second one was actually see their free float. Interestingly, the second one was how much of their revenue was technology driven. So we identified some companies that are considered technology, but when you go through their balance sheet, you realize the majority is finance, oil and gas. It's retailers that have an element of technology. So more than 50% of the revenue had to be technology sourced revenue. So that eliminated some. And then when we started looking at the free cash flow and the actual size of their market caps, some didn't meet their minimum requirements. And we lowered it relative to the MSCI, because obviously the MSCI is at a global level or regional, but still that removed certain companies. So the final ones that we identified were 15 that met the criteria. And again, I'd be happy to be challenged on that methodology, but that was the methodology that we used. And we'll continue to review every quarter inclusion of other companies. So when it comes down to the number, that's the number. Not one of those companies is listed on any MSCI index. So the Middle East is underrepresented in global technology indices. And we're looking to see if we can replicate that for Southeast Asia and Africa so that the geographies that MAGNiTT covers can be looked at. But ultimately, I mean, it's an interesting one that I'd love to get your take. I mean, you're an expert to a certain extent in this space, having done a listing. I think the mindset of the investor in the region is different to that of the international investor. Their dividend yield generating investors, the retail investors, is stock picking for things that can be. So when you look at the Amars, the Salex, you look at many of the investments that have been listed here in the region, tech companies aren't generating those type of yields. It's capital returns. It's kind of much more growth driven. That's not the performance that we've seen here in the region. And therefore, the appetite for them has been a challenge. On the regulatory side, yes, completely understand. It's something that, again, why we created the indice, because some of our clients are the regulators. And we told them, great, this is the performance. Because I've sat in meetings where VCs are like, nope, we need to have more IPOs. We need to change the regulatory environment. Okay, but this has been the performance of the ones that have. Now you have data. Now we've put an index. We can discuss the methodology. This is the index. Now we can discuss individually why some of these companies have challenged. I'm not an expert in those companies, but now you have a framework for discussion. And so, I mean, I'm very interested from your perspective. There's a regulatory side, but have you seen, based on your experience, the appetite of the regional investor for tech companies?
No, definitely. There's an inherent investor conservatism in how they look at things, and it is a predominantly yield-driven market, with growth being an add-on as opposed to kind of a predominantly growth-driven market. But it's also chicken and egg, because I think you need to have, as you said, success stories to convince investors otherwise. So you can't also, the behavior is not going to change on its own. So until kind of there's a regulatory push to kind of do more, and banking push to do market growth companies, and these growth companies do well, then the sentiment will change. But if we wait for the investor sentiment to change from yield to growth, then we'll be stuck forever waiting for that.
Absolutely. And there's also a chicken and egg, because I've had conversations with investment banks. I mean, investment banks doing research on tech companies do research to do the listings. But if the companies aren't likely to list and they're unlikely to be successful, then they're unlikely to do the research. So there's a space there that needs to also be developed. What type of companies, what are the problems, what are the opportunities, what are the challenges that they need to face to create an element of transparency. And this is an open invitation. I'm happy to support in any kind of forum, but that was the point of the index, is now you've got numbers. Because I've sat on so many conversations with VCs, and we need to see listings. We've heard many companies that are coming up to listings. Number one, you need to see what's happening in the US. SpaceX, boom, explosion. Where is it now? I believe it's below its listing price. You now are talking about SK Hynix up. Is it going to stay there? So what's happening in the US with regards to these listings? We actually did a report 2-3 months ago where we benchmarked the US listings for the last 2 years in tech. And actually many of them are down on their listing price. So great. Even the US market has challenges with regards to listings of tech companies. So why would it be any different here, regardless of the investor appetite and the regulatory framework? Albeit now we're seeing kind of this continued growth and appetite for AI and technology at a global level, which many people may consider a bubble. Maybe people think it's sustainable. I mean, that's a whole debate in itself. But actually, when you even look at the 15 companies, they're not AI solutions. These are not the semiconductors. They're not the Microns, the TSI. No, they're the Talabats, the Rassens, the food and beverage, Jahiz, etc. They're more traditional technology companies from that perspective.
Now, we talked about secondaries and IPOs. Let's go to M&A. Now, there is a concern that in the last 10 years, the M&A coming in, or the players entering the market, was mostly coming in from the West, right? So Amazon, Uber, Delivery Hero. So they were more likely to acquire, and that created some exits through M&A. But currently, the wave coming in is coming in from China, whether it's basically Kita, whether it's ByteDance, whether it's Shein, etc. And Chinese companies in general, they tend not to acquire. They tend to come in organically. So that actually creates a risk of even less M&A going forward, and just companies organically losing market share to these very aggressive Chinese entrants. So how do you see that?
Yeah, I mean, again, there's two parts to that. So I mentioned the point: 25% of the acquisitions the last 10 years have been international, outside of the region acquisitions. And yes, it has been a very strong story to have an international entity look to acquire for regional expansion. Again, geopolitics. Are those companies now coming to the region? Are they firm believers in the region? Do they have a medium to long-term view for the region? What can be done to continue to support? I'm very bullish in the Middle East, clearly, and all of us that are here have strong convictions on the opportunities and the development of the region. But at the moment, uncertainty is kind of the devil of decision making, and it pays for those international investors and or acquirers to wait and see. So just from a data perspective, I started the year off the back of a record year of venture capital investment in the region, positive sentiment, a lot of bullishness in the region, thinking that this would be a record year of M&A transactions for people to come and take benefits from that. Now we're in an environment where I think it's going to be one of the lowest years of M&A. Somebody asked me an interesting question. One of the fund of funds said, okay, what did we learn from COVID? In COVID, similar thing. And remember, COVID started first week of March 2020. The geopolitical situation now started the first week of March. And then you saw what the impact was. Interestingly, M&A picked up in 2021 because the successful companies at that time, e-commerce, logistics, started acquiring regionally in 2021 and 2022 when the winners started consolidating in their sectors. So I wouldn't be surprised in the AI space, finance space, that consolidation is likely to kick off in 2027, but in the next 6 months, it's likely to slow down. On the point that you were making, an opportunity that I have been personally quite bullish on since I went to Singapore for work, where we launched Singapore and Southeast Asian data on the platform back in 2023, is that there is an opportunity to focus less on the West, but on the East. Southeast Asia as an ecosystem has a lot of learning lessons for the Middle East. When you look at the size of the market in Singapore, 5 million population, very similar to the UAE in terms of structure, attraction of capital, a financial hub, connecting logistics hub for Southeast Asia. But again, from a scale perspective, 5 million population is not big enough. You look at Indonesia, Malaysia, Philippines, Taiwan, same kind of concept from the Middle East. They have to scale into bigger markets. You look at Saudi Arabia, you look at Egypt, you look at many of the geographies, Pakistan, Turkey, if you want to look at comparable type geographies here in the region. But they also have the same challenges of scale, bureaucracy, regulation, language, all of the different same challenges that Middle Eastern companies have. But as I said, companies need to look global. And there is a growing relationship that's being developed. There is Leap East that's happening right now in Hong Kong. Singapore have several fintech conferences that DIFC goes to. And they have the same exit challenge that we have here in the region. And they have the same sovereign wealth funds, Temasek, GIC, who have all deployed big capital. And if I always say that if you consider the Middle East now to be entering 11, 12 years, Southeast Asia has been having venture for maybe 17, 18 years. So it's more developed than the Middle East. And many companies aren't being listed in the Southeast Asian ecosystem because they haven't got to scale. They have a lack of appetite for them. Is there an opportunity of consolidation of a Southeast Asian company with a Middle Eastern company? 1 + 1 = 2.5, unlocking two geographies, companies consolidation once they've merged into a much stronger proposition, Islamic finance, Islamic travel, Islamic language content, media content, transport and logistics. Are there opportunities from that perspective, rather than looking at the West and Europe, that can unlock synergies for companies that become more attractive for IPO listings? On the China level, yes, I mean, that's a different beast. I've been in several conversations where many founders have been frustrated for the way that those type of companies. But I think if we go back, and again, I'm not an expert in this, but if you go back, Uber did the same thing. Uber came to the region and started competing. And at some point, I'm not saying Uber and Chinese companies have the same capital or political ambitions, but at some point it became easier to acquire. But it took a good 2, 3, 4 years. I mean, Uber came while Careem was being developed. It took 4 or 5 years before that came to fruition. The Chinese companies have only been in the last 1, 2, 3 years starting to come to the region and compete. So will there be opportunities in the next 2, 3 years that these companies just go, you know what, it's easier for us to acquire now than to build organically? I don't know. That's a question. But clearly it's become a point of friction for many of the companies that are building locally because they do not have the capital to compete with a Chinese counterpart that is coming to the region with capital from China for certain industries. And so that has definitely become a pain point that needs to be discussed and addressed.
You talked about the idea of merger between startups to achieve more scale. So not an outright acquisition by one, but rather a merger between the two. Now, this makes a lot of sense from a scaling perspective and getting closer to late stage and IPO. However, the major challenge that founders have here is that these companies tend to be, both of them are still burning. And when they approach VCs and investors with a merger idea, a lot of the feedback they get, okay, then we need to see the merger close and we need to see the integration and how it looks like before we fund. So they end up with a double problem. The burn is now bigger because they have the combined burn, and actually raising funds become more difficult during the time of the merger. So how do you solve around that?
Great question. And I don't have a solution. I'm suggesting ideas, but I think these are the type of conversations that need to be had, right? What I've been a big advocate for is what have been the success stories? What are the learning lessons? And again, from a geopolitical perspective, if this is a conversation that the UAE government wants to have with the Saudi government, with the Singaporean government, if when Saudi Arabia are doing roadshows to international markets, if one acquisition is done, if two success stories are developed, if a pattern can be developed, then it becomes interesting. But is there a conversation that needs to be had? And I don't have the answer to that. Maybe my theory doesn't work, and that's fine. But at the moment, scale to exit has become one of the biggest, or has remained one of the biggest challenges for companies that have looked to get acquired or list. And therefore, let's call a spade a spade. That's the problem. How can we solve for it? And I think that there's a lot of conversation that can be had around this. There are enough genius people, including yourself and others, who, I mean, all of the Kareem Mafia, the Swivel Mafia, the original Souk Mafia of entrepreneurs that have then gone on to build businesses, all have pain points and challenges that could be brought together, identified, and solved for. But again, that kind of goes above my pay grade. But someone needs to take the problems and then start thinking about solutions rather than focusing on how do you focus the infrastructure or the licensing and etc. Now we're getting to a point of the success stories becoming part of the issue that needs to be solved for.
When you give examples, you are often referring to AI, fintech, infrastructure, defense. And today that's becoming part of the problem, right? There's an over-concentration from a sector as well. And you talk to, for example, founders in education technology or health tech, etc. And it's a real struggle to raise marketplaces. It's a real struggle to raise capital outside these core sectors. And founders are often caught between, do they just reinvent the company as an AI company, even if it's not, to try to fit into a fintech, or otherwise capital becomes very challenging. So how do you see that point?
Look, I mean, it's a great question. I've spoken about this to a certain extent. I mean, in any market, let's take a step back. Success breeds success. Risk appetite grows when you have bigger risk capital. And so it goes back to the question that we were just discussing. If VCs have not seen returns on investments, they will always choose to invest in the quickest path to an exit. And if the quickest path to an exit is in fintech, because there are global acquirers who are interested in the region, if it is the industry that sees the fastest growth, if the e-commerce and marketplace has already been consolidated and that evolution, we go back. E-commerce was the first wave of the marketplace. We've already seen the big consolidation and acquisitions that have taken place. Transport and logistics is naturally the second pain point. And there are a lot of similarities. These are point-to-point platforms that are solved using technology, one for goods and services. The second one is for logistics, people and cargo. Now we're doing it in the financial services space, which is still predominantly money-driven, like point-to-point transfer of funds rather than being complicated solutions that may be outside of that. And therefore, it goes back to the point that VCs will naturally invest in the industry that is likely to have the quickest path to exit. Until you start seeing, and even if we go through the MAGNiTT directory, we have a whole funds directory. Interestingly, we have close to 1,000 funds that we track now across the Middle East, Africa, Southeast Asia. How many of them are specialized funds? And even if they're specialized, they've now become specialized by stage and not by sector. And the only specialized funds that started emerging, we just did a report in the last 2 years, AI, fintech, because there's a mandate for the quickest returns. And so it is literally a chicken and an egg. Should there be more money going into healthcare? Absolutely. Should there be going into education? 100%. But who's going to make that investment? Given where are the exits going to come from? How scalable is the product? And more importantly, when you really look at other ecosystems, and it happens, but I don't know how it could be better kind of supported. Research and development comes from government. It comes from university. It comes from endowments. Many of those type of sectors require capital investment in research and development before they get to the venture capital stage, which is the scalability of the product. But before they get to that, you need to think about the IP, you need to think about the research, the development of the hardware or the software that is more complex than a fintech solution, which is a payment platform. So I think it is literally the chicken and egg and the risk appetite that comes from success that will drive the other sectors. And again, the last 5 years have just been a challenging evolution in the market.
And I think one of the countries which are very representative of this fintech concentration is Egypt, right? Where effectively your three publicly listed companies, Fawry, Value, and eFinance, are all fintechs. And even if you look, the biggest private companies pre-listing, whether it's Halan or Thunder, are also fintech. So it is very clear that this concentration has happened. But even within Egypt, even after all of these success stories, you're still seeing today relatively limited VC funding from the Middle East going into early stage in Egypt, even in fintech, even after a couple of years of relative currency stability and macroeconomic stability. So what's driving that?
Great question. But again, follow the money. We talked about the LPs. Where is the LP coming from? It has been predominantly, and we are now mapping out the LP ecosystem. So just to be like what we're doing at MAGNiTT, we started the year by trying to work towards DPI calculations. To be able to do DPI calculations, we now have a mapping of all of the funds in the region, specifically the top 200 most active by funds. We now have the exits that they've done through M&A. We're in an exercise now of mapping out all of the secondaries to be able to do that. We now have the IPO report on all of the exits to be able to see what the potential proxy for a DPI calculation or a MOIC and TVPI. Now we're in the process, along with the secondaries, of mapping out all of the LPs that have made investments here in the region. Family offices, endowment funds, many of which are not disclosed, many of which will be another challenge for us to be able to capture. Why do I say that? When you follow the money, many of the fund of funds have geographical mandates. And so we have seen a concentration of capital in Saudi Arabia and the UAE for the last 4 to 5 years. Many of the credible, strong fund of funds that we've already mentioned, SVC, Jeddah, DFDF, Mubadala, etc., part of that mandate will be to invest in local companies. And so many companies that have been in Egypt have relocated headquarters to jurisdictions to be able to capture the capital. And MAGNiTT may be part of the problem because then we record it as a company that is in those geographies. And they may have back offices, they may have infrastructure that remains in Egypt as an ecosystem. Jordan, a very fertile ecosystem for engineering. We work with their fund of funds, and they specifically recognize that many companies will get early stage funding within Jordan and then have to relocate for scale, but they like to track those that have migrated. And so part of the problem there is that the majority of the LP funding has come from the GCC, and as part of that mandate, have had many companies relocate to be able to capture the investment that then comes from the GP level, because the mandate is to invest within those geographies. The second question that I'd love to hear from you, I guess, from an Egyptian perspective, the ecosystem there has had many challenges, whether it's the devaluation of the currency, whether it's the Russia-Ukraine war, whether it's the unit economics for companies to be able to operate in. I mean, there was a time, as I mentioned, that people would scale into all geographies to get numbers. There's no bigger country in the Middle East and Africa than Egypt that would make the most sense from a scalability perspective. Try to make that unit economics work, and then many companies go, actually, we now need to refocus in countries that have much stronger unit economics, and you start going to the UAE and the GCC and Saudi Arabia, and maybe you look at Turkey. So from a unit economics perspective, that becomes challenging. And then when you look at the ecosystem in Egypt, who are the equivalent fund of funds and VCs that Africa as a continent has tended to be supported from an LP perspective from the FIs, international institutions, the IFCs, UK-based investors and LPs, very different to the GCC, where it's been focused more on the family offices and the LPs. So I think part of the answer to your question is that, without really knowing the structure of companies being set up there and their ability to raise funds from a local VC at an early stage perspective. But I don't know if you have anything to share on
I
that.
fully agree. I think also one of the things is in Egypt, in the start of the boom, 2017 to 2019, a lot of these companies were relying on the middle class, which had a reasonable purchasing power and allowed these companies to scale. This middle class has had real issues over the last 5 years because of the reasons you mentioned, and their purchasing power was completely decimated, which kind of left kind of the society very kind of bifurcated between a relatively small, high-end society, which can afford a lot of the international comparables as well, and hence may not necessarily be consuming local products and local startup outcomes, or kind of a very large lower income population, which is very difficult for them to consume these startups, etc. Plus, as you said, also on the licensing side, some of these companies, they move here not only because they move to be kind of, let's say, within the geofencing of the capital, but they also move because we don't have necessarily clear English law offshore jurisdiction within Egypt. So if you want to set up in a free zone or English law and attract global capital, you need to have your holding company outside Egypt in the most cases.
There you go.
Now, Jordan.
Yes.
Jordan was the start of the ecosystem. A lot of the success stories came out of there. Now, granted, it's a small market. I understand that. But you can still have your team out of a small market and then sell towards bigger market, which is how it started, right? So even the big success stories out of Jordan, they were always looking outside, and you have companies like Jawakir, etc., where a massive user base predominantly from outside Jordan. Today you have a bit less of that. You still have companies, you have a company like Maqsam, you still have some companies, but it's not as massive as it was before. What changed?
Look, again, and it's not just Jordan. Look at what Lebanon was creating at the time with the circular that they created. The central bank was focused on this. If you take a step back from that, what is it that founders need? Education. And some of the best education systems that exist is Lebanon, Jordan, Egypt. I'm Iraqi. At one point it was Iraq. You have all of the foundations of people in technology, engineers, right? You could almost argue that, like, how many engineer-focused founders are there in the region? Because the majority of the founders are business people that then start building platforms. Whereas in Jordan or Lebanon at the time, there were very strong institutions and educational systems that allowed for engineers to set up businesses. And at the time, with relatively small capital, you were able to hire people within Jordan. But we go back to the problem that we discussed already. What is the biggest, and you know this from your experience, scale is the most important metric for tech. And so Jordan as a country does not provide scale. And so once you need to get to scale, you're talking about regulatory hurdles, demographic hurdles, purchasing power, challenges of entering markets that requires capital. And so then the next question becomes, how do you get the capital to be able to achieve that? Well, I need to now go and enter the GCC to be able to raise the capital. We work with ISSF. I mean, they're an excellent fund of funds. I have a huge admiration for Mohammed and the team that are working there. They have just acknowledged that many companies will have their back offices in Jordan and then operate in other jurisdictions. And if they can support that model in whichever way, and it can be tracked, they will continue to monitor the evolution of companies that can be successful, born out of Jordan, but have their back offices there, and how many people can be employed, and how can they nourish the education system. But if you want to get to scale, it's very difficult to remain scalable without capital. And so then you follow the money. So it's not that the ecosystem hasn't necessarily developed. It's just also the sizes of capital. I mean, I've been doing MAGNiTT for 10 years. I mentioned at the beginning when it was 200, 300 million and 20, 40, 50 million would be coming from Jordan, your percentage share of that market is much bigger. When you start going into the billions, your 200, 300, 400 now becomes a much smaller percentage of the companies that are Property Finder and Kitopi and raising your General Atlantic round and your KKR round. So it gets a smaller representation, but also many of those companies have now had to move their headquarters to raise that capital. So I think that one thing I've been quite interested in is how can many of these places become specialized hub? I mean, if you take the US, it's fascinating. Again, not to compare, or even Europe to a certain extent. But you have hubs for finance in New York. You have hubs for oil and gas in Austin. You have hubs for AI and technology in Silicon Valley. They're not all trying to compete on everything. Naturally, over time, you have specialization. So what becomes the specialized hub? I mean, at one time, I remember Kuwait with Talabat became a food hub, and many food tech companies were going and setting up and clustering based on a sector. Bahrain was the forerunners of finance, and the Bahrain FinTech Bay was meant to be the kind of location of financial services. Now, obviously, ADGM, DIFC, Saudi Arabia have focused on financial services, and that becomes quite competitive. Is there an opportunity for specialization of talent, companies, as opposed to everyone trying to achieve every sector? Is there a natural sustainability hub that needs to be created that can cluster people together based on specific sectors? Does Egypt have a specific niche that it could be developed into? I mean, these are questions, but if everyone is just trying to compete on everything, you just end up not really having the success metric. And I think the success metrics are wrong sometimes. Funding is not the best success metric. People are obsessed with how much funding is going into a geography, but I don't think the success metric comes from funding.
What's success for you?
For me as MAGNiTT, or for the ecosystem? For the ecosystem, I don't know. I mean, I always say I'm not government, nor am I a VC. I am a founder, and it's funny because I try to be as objective as possible. I always look at the data. And I remember several times, I have several instances that I could share, which I won't name, where people say, but you are wrong. And I'm like, why? Well, the market is saying something different to you. And I said, look, this is the data. And 6 months later, because there's always a lag, the data reflects the reality. But I like to just call a spade and see what it is. And this is what it is. What is metrics that could be success? Employment, except employment. If you have a lot of money, you hire a lot of people. It doesn't mean that it's necessarily a metric of success. One of the hardest ones, again, it's something that MAGNiTT would like to do, percentage of GDP of revenue that's been generated by these companies. But then it's very difficult to apportion a Swivel's revenue from Saudi and UAE and Egypt to the GDP of individual countries. Well, Swivel actually probably you can get that because there's more listing. But other companies that are private are not breaking down their revenue sources to be able to say this is proportion to this country to that. But as a percentage of GDP would make sense. I'm not a fan of unicorns as a success metric because actually it's a great goal and it's a great kind of directional goalpost. But the reality is we need more 50, 100, 200, 500, $1 billion exits. And the 1 billion is the unicorn, but there's plenty of other companies that would be great to see. I think that we've created benchmarks for some of our government clients on MAGNiTT with real-time data. And I always say, one, how many companies are getting funded at the early stage? Like, let's not forget the funnel. You need to have a continual flow of early stage. And we've highlighted this to some government entities and said, look, you see where the problem comes from. If early stage stops, then who's the next Series A, Series B, Series C? So we almost have like a dashboard that has every stage of funding. And if the goal is for total funding to grow, for the sake of argument, 30%, it's almost like every stage needs to grow 30%. If there was 100 deals that were done at seed last year, you need 130 more next year. If you had 50 deals, you need the equivalent. And then you have a benchmark on each level. International participation, I think, is interesting because it shows the maturity of the market. But for instance, Saudi Arabia has 80% local investment. The UAE has 80 or 70% international. Both tell two very different stories. And if you look at Singapore, it's closer to 65%. So a more mature market, 65, 70%. Both of them have arguments as to what needs to be done to develop that moving forwards. So I think that's a second. Exits from all, not secondaries, because I think that's exchange of capital. I think M&As, IPOs is a metric that could be looked at that doesn't need to be total funding. And I think that total funding is the wrong metric to a certain extent, but it's the one that's easiest to identify. And ultimately, employment is a gauge and revenue as a percentage of GDP are some of the metrics that I would be looking at from a government perspective. From a success metric, DPI. I mean, ultimately, how successful are the VC funds? And that's a challenge that I have with some of my colleagues and other stakeholders in the ecosystem to create transparency. Because even if the number's not great, let's see what needs to be done to see it improve. And if the number is good, then there's a great story for us to sell to get more funding in the future. So I think there are several metrics that aren't publicly shared because the headline is always total funding, total number of transactions. And even total number of transactions needs to be broken down as to where that capital is going.
DPI being the distributions from the funds to their ultimate LPs.
Yes.
You're Iraqi. You're our fifth Iraqi guest on the show between
Excellent.
the English and the Arabic. It's almost 20% of our guests to date. It's the
Wonderful.
second highest after Egypt. And I think it's a testament to the depth of the talent in the country. Our last episode on the Arabic show was with Munqidh, the founder of Bali, which is a huge success story, millions of customers and drivers on a super app in Iraq. So clearly the talent is there, the success story can be there. What is the data telling you about Iraq and its future?
I mean, that's a difficult one because the data on venture is challenging. I know that you had Shwan. Shwan is a very good family friend. And I saw Lena was on the show as well, who I know very well. And it's great to see the talent that's coming from there. It's a reporting issue that we have. Venture as an asset class, if you go back to 10 years ago, it's the confidence investing into an ecosystem. So what do I mean by that? We know that the majority of structures are BVI Cayman Island that then need to be invested into a local institution. I'm no expert on Iraq's venture ecosystem, but when it comes to licensing and structuring, I am sure that there is a lot of challenges for companies that are based in Iraq to have the right books, structures that give confidence to an investor. Maybe at seed, and Shwan can speak to that, there's more risk appetite for angel investors that are taking on that risk for the opportunities. But if you're going to General Atlantic and you're going to KKR and you're going to Blackstone, if you're going to MEVP and you're going to Beco Capital, you need to have very good reporting standards to be able to justify that level of investment. And I think that infrastructure, and again, I'm no expert, so I'm happy for someone to prove me wrong, needs to be developed to build the investor confidence. And I think if you went back to the Middle East 10 years ago, they would say the same about the UAE and Saudi Arabia and Jordan and Lebanon, and a huge amount of work has been done, ADGM and DIFC and structuring of licensing and things in Saudi Arabia to attract international capital. You have the same discussions now, which is why the foreign ownership in Saudi Arabia has opened up to see more capital come in from a public markets perspective. But I think that the same can be said for jurisdictions like Iraq, and that infrastructure layer needs to be developed to give confidence to the investor to continue to deploy. And in the absence of that, it doesn't mean that their capital isn't being deployed. I'm sure many of them have jurisdictions in ADGM and others, but within the structure of Iraq, the bureaucracy, the corruption, the challenges that you have for licensing, employment, and etc., could be a deterrent. But if there is more that can be done to give confidence to investors, you are likely to see more capital going into the Iraq from international venture.
One of the other geographic challenges we have in the region is, let's say, from Egypt passing through the Levant and the GCC and Iraq, you can argue that there is some relatively kind of multiple stories of expansion in between these countries. Now, when it comes to North Africa, Tunisia, Morocco, Algeria, etc., becomes very different. You see very limited expansion either way between, let's call it, the eastern side of the Middle East from Egypt until Iraq, and then between the western side with North Africa. What are you seeing from the data? What's driving? Is it just the language, the French versus the English? What's driving that?
It's a great question. I don't know, but I can give you an anecdote and a story. I went to Turkey in 2019, invited by the commercial attaché to try and understand how MAGNiTT could start capturing information on Turkey into the ecosystem. A person that I met who had something similar to MAGNiTT, was a data company in Turkey. I asked him that question. Why do Turkish companies not come to the Middle East? Again, there's geopolitics, there's language, there's regulation, and etc. He sent out a tweet. He had a big following. And there was something like 300 people that responded. And the questions were language, I think it was politics, I think it was market. And then the fourth response was, and it was Turkish, but it was translated, we have not been shown the way. And close to, I think it was 70% of people had said, we have not been shown the way, i.e., success breeds success. If there were more examples of companies that have done it and people that you could speak to, it is more likely that other people are doing it themselves. Now, again, I don't know North Africa as well as the Middle East. Clearly, there's going to be questions around language and the likes, politics. But in the end, it was thanks to the likes of Kareem and Souk and founders that scaled, that had VCs who could explain to their portfolio companies how to scale into the Middle East, that encouraged other people to have a blueprint that could be followed. And not to say that there aren't examples of Turkish companies that came to the region, but have they been highlighted? Because in Turkey, they all go to Europe. They all go to Germany. Turkey is a huge market. In fact, it has one of the best gaming industries in the world and the highest success of exits, whether it's IPO or acquisition, to capital deployed, because many of them have been scaled out of universities and institutions in Turkey. But the case studies, you can speak to your guys at Vault Lines who have tried to scale from Turkey, Insider, there are examples of them. But have they been inspiring enough for other Turkish founders to look at the Middle East as a market entry because of the challenges that come with language, politics, and kind of scalability? And so I don't know. Could that be part of it? I can't speak to too many examples, and there will be some if I go through MAGNiTT, of companies that have raised from the region, scaled into other geographies. But if there haven't been great case studies, then other people aren't inspired and they stay within their comfort zone. And it goes back to the same thing I said about Southeast Asia. There aren't many examples of companies that have crossed within both jurisdictions. But if that became a recurring theme, other people would follow. You saw that with Pakistan. Pakistan at the time wanted to scale. You had a couple of companies that successfully raised in Saudi Arabia and the UAE, many trade delegations that went across both. Geopolitics supported, and now you have very strong relationships between companies that are based in Pakistan going to Saudi Arabia, back to Pakistan. So success breeds success. And I think that's part of the reason that we don't see it happening as frequently as we anticipate.
True, and I think we've also seen the same around East Africa, right? Similar to Pakistan and Turkey at some point, a lot of bullishness around Kenya, Tanzania, etc. But again, kind of goes through cycles. And then also, if you look at kind of North Africa, its integration a bit with West Africa, you've seen some Moroccan companies go there. So I think because all of this, as you said, the market is still relatively small, and all of this becomes critical towards creating a larger market.
Yeah.
Now, I want to go back to what you talked about in terms of the current kind of geopolitical event. So obviously, one thing you said is that still the impact may appear in Q3. It's too early. That's what's happened in COVID because deals take time to sign. But also the other thing that may be encouraging is that even if these deals were already pre-agreed and pre-negotiated, etc., but the fact that they still got signed means that people did not pull out last minute when the events happened. So does this give you confidence that kind of we're more resilient this time?
Yeah, I mean, the things that we looked at, we put out a research piece that came out within 2 weeks of the onset of the geopolitical situation, because I went through COVID. Everyone went through COVID, but with MAGNiTT. And there are a lot of learning lessons that you can see from COVID. The impact of COVID, which is completely different, but from a data perspective. The data, as I already highlighted and is published in the report, which will be out by the time the podcast is out, Q2 data is pretty much deals that were in March that were not announced because it was not good taste to do it during the conflict, that then were announced in April, May. Some may have been new deals, but it was a buildup. Exactly the same pattern that we witnessed in COVID. Everyone was telling me, how are all these deals, how come that Q2 was stronger than Q1? And it was kind of counterintuitive. But that's where we learned these were deals that were already coming. They were paused. Everyone was at home. People were panicking. Not great to do a $15 million announcement in the midst of COVID when everyone's sitting at home and people are having problems at the hospital. But then as things kind of developed, people started making the announcement later in May and June. So there's some of that. Then Q3 happens. Well, we're in the midst of the summer. Dubai is already getting a little bit quieter. People are traveling. People are going on vacations. What is deal making? Now, we have more technology now. People are doing things on Zoom. But in the end, You know this, Yusuf. It's the interaction. If you're going to put money into someone, you want to meet the founder, you want to understand their business model. And there is still some level of apprehension with what's happening from a geopolitical perspective. So naturally, I think things will be pushed into September. Now, September, I remain extremely bullish. I think people will kind of move on from the situation, assuming that the MOU comes to fruition and that there's kind of a longer standing peace deal. And with every crisis, there's opportunities that will develop. But immediately, and we know this specifically here in the GCC or in the UAE and Saudi, we started having conferences that were meant to be happening at the beginning of the year that are pushed to the second half of the year. FII, you got Leap, you got GITEX, you got Money 2020, many meetups people will start going back to, which becomes the fertile ground for interactions. Investors, startups, governments, people are now on their vacations, they're doing roadshows, but they'll come back and they'll start going back to the international attractiveness of bringing people back to the region. The winners will be proven, whether it's aerospace, defense, cybersecurity, AI. Everyone will then have a period of 4 or 5 months to show their revenue growth or decline, how they pivoted, how they dealt with the crisis. And therefore, we will start seeing that come through in the data with regards to the type of companies that will have raised and those that wouldn't. But again, I go back to the pillars that we look at as MAGNiTT, which is a dashboard that we will create for our clients. One is international capital. And we have already seen a slowdown in Q2, but I believe that was already happening from last year. In terms of the capital that's being deployed, 50% of all capital and investors last year came from outside of the region. That number has already dropped to close to, I think it's 25% of capital coming from international markets, and less than a third of all investors are international. Heading into Q3 and Q4, I only anticipate that number to decline. The amount of late stage capital, it is always riskier at late stage than it is at early stage. And we have already seen, while there remains bigger deals and a larger percentage of deals have come from late stage capital than early stage capital, it is significantly lower than it was last year, that dashboard of stages. The early stage funnel, let's remember, it's difficult to raise. People with their personal wealth, angel investors and seed investors, are looking at the public markets at record high, focus on that, investing abroad. So the pipeline of early stage has also come down. That's one of the metrics to look at. M&A, exits, we already discussed. And then what are the LPs in the region? The GCC concentration, the UAE, Saudi. What are the mandates to focus on in a crisis of that capital? Now, naturally, people will be focusing on defense, infrastructure. There's much bigger problems, shall we say, that need to be addressed. But now is the time to invest. And how will that look from an LP perspective? On the opportunities, as with everything, there will be new companies that will come out that will solve for regional problems at a time of crisis that didn't necessarily exist outside of that. The winners, potentially in the AI space, will now start to think globally. I've spoken to many VCs who are now encouraging, if there were companies that were at a certain stage, not to be GCC concentrated and to look at Southeast Asia, Europe, the US as opportunities for growth and to relocate and or set up remote offices. So I think that the mindset of a founder here in the region will slowly shift while continuing to remain within the jurisdictions here that still have some element of capital that can support them moving forwards.
Another type of capital you talked about a lot is private debt and private credit. We've had Army from PFG on the show.
Yep.
We've had Ru'ya, etc. Now, founders often complain that capital is still very much concentrated around fintechs and kind of building the float that fintechs need. So a bit of a similar problem to the venture kind of equity side of things and the venture capital side of things. And also a lot of these funds you don't have a lot of like homegrown funds coming up in that. Some are international, some again are seeded by governments, etc. Where do you think the kind of the gap and the limiting factor here in the debt availability for startups is?
Look, I mean, I think there's a big appetite for debt. It's been a global phenomenon. I mean, private credit globally, but then you also have the concerns and the canary in the coal mine of some of the debt situations and even BlackRock. And we've kind of forgotten about that. But at the beginning of the year, they were pulling back funds from many of their global funds. But there is a lot of appetite for debt. It's the third pillar that MAGNiTT looks to continue to develop. So we have venture capital, private equity, and debt is an area that we're interested in, starting with venture debt. The challenge is that it goes back to what we said. Many of the companies that are able to raise venture debt as an asset class have to be profitable, or at least have a clear path to profitability to be able to justify. What we did is actually we looked at our database. We identified, I think it was the team told me the other day, because we're going through them, close to 400 transactions that are equity debt. The majority of transactions in venture debt, not private credit, are an equity round, either as collateral or to support, that are then complemented with a venture debt round that helps with scale. And so again, it's a little bit of a chicken and egg. There isn't a huge amount of transparency, and Army does a fascinating, phenomenal job, and some people talking about it. But what type of companies? We actually did a report when Shua Capital were focused on venture debt that talked about the fundamentals, and we still have it on MAGNiTT, which I'm happy to share. But what type of companies actually are venture debt related companies, and which ones are not? And you start looking at mature companies, path to profitability, have clear receivables, and etc. Private credit is very difficult to track, and I think it's a growing market. The regulators are keen to try and understand how much private credit is in the market. Lines of debt for late stage, we've already seen the likes of JP Morgan, Goldman Sachs participating specifically in the buy now, pay later space. So it is a growing market. But again, having spoken to a few of the providers, the instability of the region immediately impacts the business models of some of the companies that can be either an opportunity or risk for the providers. And therefore, that's a conversation that needs to be had to understand how to encourage more capital flow from a private credit perspective.
On the banking side, as you said, it's been mostly the international banks, right? It's been JPM with Tabi, GS with Tamara, Citi with Bottom, Astratech before, etc. Where do you see the local and the regional banks within that framework?
I think there is an opportunity. I mean, I go back to the corporate report. It was amazing. So we did this corporate venture capital, corporate investment report. I'll answer your question, but just take a step back. Corporate investment report. Why? Because we speak to so many of the corporates, and each one doesn't like to be considered as corporate venture capital, because there is a stigma with regards to corporate venture that once you've raised money from corporate venture, either it's a path to an exit, because why else would they be investing in you? Or that they might put restrictions on the company that a venture capital company isn't comfortable with, because they might need them to sell products. Or so they like to consider themselves as off balance sheet and different type of structures. And so we identified, I think in the report, close to 8 types of structures that looks at corporate venture. I think that corporate venture, as we said, accounting for only 12% of all venture in the last 5 years, has huge room for growth. Banks have tried to become digital first. We've seen the likes of Mashreq Bank do neo ventures. Emirates MBD has made some investments. But I always come down to KPIs. A venture fund has an 8-year mandate with a 5-year deployment window, and they take management fees. A corporate, unless it's structured as a fund, will have almost 1 to 2 year KPIs that are not necessarily in line with what a startup is looking for. And therefore, how do you align the interests of a corporate with the objectives of a startup? And so banks have tried to participate in this space. But again, with all of these type of geopolitical instabilities, they also go back to their core business. Their core business comes down to retail banking, corporate banking, loans, deposits. Interest rates have continued to stay relatively elevated. You get great net income earnings just from doing so. Real estate, which has continued to be an area of success. So my first job at Oliver Wyman, when I was a consultant, was working for a bank in the region that was redefining its SME strategy. And it was interesting, and predominantly is the case, that 80% of the revenue can come from a corporate book of 100 clients, and 20% comes from the tail end of the SME. And it's more of a hassle to deal with the SME side of the business than it is to deal with the large corporate, but the SMEs of the future can become the large corporates. So it becomes a risk appetite for the institution to participate in the venture space. And herein lies the opportunity with governments to de-risk. And again, your question may have been related to financing, but even in venture, corporate investment, acquisitions, how can they be de-risked for a flywheel effect of greater participation from corporates and institutions, whether it's oil and gas, whether it's logistics, whether it's any of them, to participate within everyone's digitalization. Many companies choose to do it themselves. There are great companies out there that can literally do what these large corporates are interested in doing, but the mindset is always, let's do it first. It's probably going to be cheaper. And I can probably count to hundreds of examples that either it's much more expensive or they give up on it because the person's left. The KPI is a 12-month KPI. They're not founders. They don't come with a founder mindset. And so how can they be educated in that investment in the company and or the acquisition rather than trying to do it themselves because they believe it's going to be cheaper from that perspective. From a lending perspective, I think it's just a risk appetite that needs to be developed. Your Goldman Sachs's and JP Morgan's have huge teams, huge case studies, huge examples of what they've done from a global perspective. They're applying their best practices to a local company. Here, maybe that knowledge hasn't been built up in the same way, and there haven't been as many case studies for which they can replicate.
On the non-banking corporate side, we've now seen quick back-to-back Shuruk funds with Preside and with Do. Are you starting to see that as a playbook that you expect to be kind of replicated?
I think that's a great example of how corporates can participate. If they haven't got the expertise in-house, why try to build that expertise in-house? And that is your LP. If the LP we saw in Saudi, SAB, collaborated with STB, some of the banks have now outsourced with a clear mandate to a venture entity. And I think whether it's family offices who have tended to compete with VCs in trying to get investment rounds rather than being LPs, there is an opportunity to see more of those collaborations. And again, success will breed success in being able to highlight why that makes more sense than to do it themselves. But again, one of the questions, and sorry to interrupt you, is like, we also want to see who the best VCs are. And to be able to have DPI benchmarking for the region, there's a reason that Shuruk may be one of the better VCs from a funds return perspective. They put a lot of content out there and they've built that relationship. Who are the other ones that should get backing? And what's the story that they can tell so that they can participate from an Etisalat, they can participate from a different corporate entity that may be interested?
On that content piece, so Shuru is an example of a VC that has had kind of like a chief marketing officer putting a content. They've had a podcast at some point. Some of the other VCs, you see, for example, Silicon Badia with Hussam, they're extremely active on LinkedIn, etc. And then you see other VCs which take the approach more of it's really about the founders. It's not about us. It's kind of low profile. We focus on the founders. We deal with the founders. How do you see these two approaches?
Look, I mean, podcasts in the region are always challenging because you always have to be somewhat sensitive. And I think that's what I kind of alluded to earlier, to have conversations where the uncomfortable truths can be had with regards to some of the challenges in the region, but to be constructive. I mean, I like to think that I can always try to be constructive and to try and provide solutions. One doesn't need to be critical, but for many of the VCs, that becomes part of the problem. Those that feel comfortable and are opinionated can sometimes be judged or get in trouble because they have strong opinions, and therefore it's easier to not say something publicly than it is to try and be constructive publicly. So I do think that there is generally an opportunity for people to highlight some of the challenges and provide solutions to them so that other people can be inspired to support and help rather than just talking about success story and success story and success stories. I think Lulu, for instance, does a great job trying to bring some of the founders, but in the evolution of Lulu's podcasts, she went from slightly more kind of safe questions to more provocative questions that can drive a conversation in the public domain. Whether all the VCs need to be doing podcasts or not is a different question. I think each one has a mandate. And in the end, what's the KPI of a podcast? You're trying to promote something. Are you trying to revenue generate? Are you trying to build an audience? In the end, you kind of backward engineer like the DPI model. What's the success metric and why would you do it? And if it's just to talk about something, then it's not, because if podcasts, for instance, have become so competitive, if you're going to do it, you either do it properly or you don't do it at all. So I think there's an element of how comfortable you are in what you're talking about. I mean, there's a reason that the All In podcast is the All In podcast. I mean, they've said it themselves after their 100 episodes. And open challenge again to Magnus, who I've had this conversation with, to do something equivalent here in the region. But the region who sent me the All In podcast, whether you like it, don't like it, it's changed. And again, not going into the thematics of it, but what makes them successful is that they feel very comfortable speaking. They don't take money from it. I mean, they make money in very different ways, each of them individually, but it's not kind of monetizable as a product. And they definitely have opposing views and don't shy away from challenges and confrontation, which makes for a very dynamic podcast that becomes interesting. And they talk about current affairs and specific subjects. That type of conversation is extremely valuable, but it's very difficult to have in the public domain. So it's not about whether the VCs want to have podcasts, because there's plenty of podcasts and you can listen to founder journeys and there's lots of things that you can listen to. But what makes it interesting in the noise of all of the other podcasts for football now with the World Cup or Formula One or history or politics, that means that people want to listen to that podcast.
You talked about potential competition between family offices and VCs, and you do have now some family offices which are maybe setting up their own, becoming like a multi-family office or their own fund, etc. Now, part of it you can think of it as competition. Part of it, the family office says like, this is my capital. Why am I ultimately paying all these fees on it? And sometimes also they feel that the VCs here haven't really treated them in any like special way, right? In terms of access to founders or information or like a co-invest, etc., hasn't been really special. So why don't I just poach that team or hire that team and go about it myself? How do you see it?
I mean, it's a great question. I mean, I think, again, doing MAGNiTT for 10 years, you've seen the evolution one way or the other. At the beginning, they would only be investing abroad. So they weren't really looking to, I remember when I started MAGNiTT, all the conversation was, why are they all investing abroad? They should be investing locally. And I remember to some founders vociferously talking about, it's wrong that they don't invest in the region. And that's where I came up. And I remember Danny from Biko at one of the STEP conferences talking about, if you think it's hard to fundraise as a founder, think about how difficult it is to fundraise as a VC. And what you realize, again, it's not a charity. They have LPs. They need to justify their returns. And so you go into everything that we've discussed, the DPI and how much is the returns and etc. When Kareem happened, obviously the FOMO kicked in. Should we be investing directly? Many of whom may have been given the opportunity didn't. Do they invest through the funds? Do they have the expertise? The next generation, who are the ones that are going, been educated abroad in Silicon Valley and Europe and etc., come back. They're also responsible for their family offices. And in a portfolio theory, you're looking at fixed income, you're 20, 30%. You're talking about stock market, 40, 50%. You have commodities. And then there's an alternative allocation. And that alternative allocation is either investing in specific funds. And again, there's real estate, infrastructure, private credit. And then a part of that allocation goes into venture capital. Depending on the size of the family offices, that can be anything from 5 million to 500 to 5 billion, depending on the size of the entity. And at each level, you either build the team in-house or you deploy it to the LPs, to the GPs in the region. But then we go back to the question of, who are the GPs? MAGNiTT has the data on them, but are they looking at the data? Are they benchmarked? Who are the top performing ones? Who are not the top performing ones? Who are the ones that are raising at the moment? And so there is that element of transparency, which I think, again, some of the government institutions can do to potentially even offset. I mean, if you think, it's interesting, we were looking at a specific geography, and I alluded to this earlier, the demand and the supply. If you look at all of the demand of capital, you probably need about 3x the total number of companies to get to a target level of capital from the ecosystem on an annual basis. Say, for the sake of argument, we wanted to get to a 5 billion figure for a particular geography, then, okay, 5, 3, 1, 2, you go backward and you say, okay, how many companies can actually even achieve that? And so you needed about 2 to 3x. On the supply side, we have dry powder on the MAGNiTT platform. Even if you allocate off balance sheet and family office, it's still about 2 to 3 billion of capital in dry powder. And yet, to be able to achieve that, you need about 15 billion. So where's that 15 billion coming from? And again, I'm throwing numbers just as a point of reference. So what role can these family offices play? And if you want them to participate, can you create incentive schemes, capital guarantees, which is what they do in the UK, for instance, at an angel investment level. But can there be a model to encourage greater venture participation from family offices, matching or as an LP, not as a VC fund, that can encourage them, capital guarantees on certain funds. Can you get more government institutions that are beyond just the sovereign wealth funds to participate? There are different ways that your example of matching GPs to LPs and family offices and corporates that can encourage them to participate. But in the end, to answer your question, yes, it's always been a question of why should I do it myself or to invest into the fund? And that comes down to a skill set question and a track record.
And on that skill set, one of also the challenges is that the vast majority of these VCs are specialist, generalist VCs. So you have very few specialist ones. You have Globivest, the life sciences one, etc. But these are very few. And hence it's more difficult to build that skill set if you're doing 10 deals, each deal is in a different sector, and that's it for the fund. So is it just because we just don't have enough scale to really justify specialization?
I think it's both sides, right? We discussed it earlier, like which companies need the specialization and which funds are there to support in that specialization. Yeah. If the risk appetite hasn't been grown, so take an example. If you really wanted to invest in healthcare, to be able to do that, you have to have a 5 to 10 year horizon where you know that it'll require a lot of R&D. How many hospitals are deploying as LPs into regional healthcare funds? Probably can't even count any. How many medical institutions are doing that? And so there has to be a participation from some of the sectors to create the specialization. You talked about talked about Presight. They're investing in AI. They're investing in telecommunications. They're looking at infrastructure. They are specialized funds. That is why, and again, without knowing the details, I'm just hypothesizing, Shuruk was able to raise the fund. They have the expertise on the venture side. They have a mandate. They found an entity that wants to specialize in that fund. So that chicken and egg was almost solved for. And I'm sure as part of the due diligence on the AI level, here are 30 companies that we think are potential targets. So there was work that was done to identify them. So the specialization will come, but this chicken and egg is who are the LPs that might be interested in funding the funds.
Now, so far we've spoken mostly about the first two pillars of your coverage, which is the venture capital and the venture debt and private debt. Now, you said the third pillar of your coverage is private equity.
Yeah.
Now, private equity participation into startups in the Middle East has been extremely limited. Probably I can only think of a few examples, maybe RMBV into Maksab in Egypt, very few examples around this. Again, this is partially because the private equity industry itself is very underdeveloped and there's very limited blind pool capital in the first place. But what are the other limitations you think which is kind of driving this limited private equity flow even into late stage growth type startups?
It's not completely dissimilar to VC, and I don't claim to be as much of an expert in private equity as venture. But again, you can speak to brokers, and there are several institutions, whether it's Investcorp, whether it's CBC, whether Gulf Capital, Arqam, there are a growing number of institutions that are making private equity investments. One that's interesting from the data, the majority investments coming from private equity, specifically in tech, in non-tech, is that the investment rounds are growth capital being under 50% investments, not acquisitions. When you compare that to an international benchmark, the majority of investments are buyouts and leverage buyouts. So when you look at buyouts and leverage buyouts, banks aren't necessarily providing leverage. So from a leverage buyout perspective, banks are not supporting the local VCs, or it's not in their kind of mandate to support for leverage buyouts. On the buyout perspective, the funds that have been raised may not justify the ability for many of the PE funds to do full-scale buyouts in the region. And the flip side of that is, how do the PE funds make money? M&A, IPOs. You go back to the simple question about exits. If you are going to a point of a private equity investment in tech, you usually enter at the point where you're going to be IPO listing and or have a clear path to an M&A transaction that will happen within a 2 to 3 year period, because that's your multiple. You're not an angel investor. You're not a seed investor. You're looking for an exit within 2 to 3 years. I've given you the data on the M&A transactions that happen in tech. And while it's more buoyant in the non-tech sector, they remain the same challenges given everything that we've discussed. And the IPO windows that we've seen and the performance of the IPO markets, again, lead to one of the challenges for private equities. So there's both the type of structures that private equity investors are participating in, are different to what you see from a global perspective. And there's a confidence building exercise that needs to be happening in private equity, albeit it's definitely developed a lot more aggressively. And we've seen more capital deployment and transactions in private equity in the last 4 to 5 years compared to years gone by. But on the other side, it becomes to the exit opportunities that exist here in the region, some of the challenges with those exits.
Philip, I want to transition from the ecosystem to you now and MAGNiTT. So you talk a lot during this podcast about the reports, the dashboards you put out, but you describe yourself as a data company. Now, a lot of the founders who operate in data and SaaS have a bit of a challenge that monetization is very difficult, right? They sit on this ton of data, which they kind of believe is extremely valuable, especially now with AI. But at the end, a lot of what they're doing is, let's say, publishing reports, providing dashboards, which maybe clients are not necessarily willing to pay a significant amount of it. So now if you put more of a kind of a founder hat on, how can you unlock this monetization part for data startups?
Look, it's great. It's a great question. It's a difficult question, specifically now in the last 6 months. With the onset of all of the AI tools, there's been a back and forth on being able to integrate those solutions into AI or the loss of the data that you've created to third parties. And that's something that me as a founder, we've definitely been challenged with, trying to understand MCP solutions that can be integrated into third parties, API pools. And then one behavior I think that is definitely clear is that you can have as many reports and dashboards that you can create, but people have now become used to instant gratification and results through third-party solutions. You can go to ChatGPT, and I'll publicly say this. You can go and say, talk about MENA funding and comparing geographies and industries. I guarantee you that the numbers are wrong because they will have pulled from 3, 4 historic sources, inaccurate, but it'll come with a very nice chart. It'll come with a very nice explanation. And if you start questioning it on the sources of the data, you will find that there will be many errors with that. But it saved your life because you've spent $20 and it's pretty immediate. So there has to be a lot of questioning with regards to the quality. And in the end, you're right, we're still a data provider. If it's not us providing that data, it'll be someone else, but who has more accurate and quality data. So one of the things that we're working with our clients is how can we solve the pain points for you? Governments have specific pain points, and we've actually started developing proprietary dashboards, either through solutions that they're building and or on the MAGNiTT platform that they track on an ecosystem level and for the institution, which we then become the proprietor of the real-time data. The second one is LPs that are looking for fund performances, and they are now looking at the benchmarking, which doesn't exist. Let me be clear. It's not like you go to PitchBook and it's going to be any more accurate, or you're going to a third-party provider elsewhere. I guarantee you are more comprehensive and more credible in terms of the data sets for the region, but then we don't have the international benchmarks. So that becomes a pain point. But in the end, I've been very clear to the team. We've got more data. You can create more proxies. You can create more variables. You can get insights from the market to enhance the models. The challenging question is, do we now start selling the data as individual line items through MCPs, through APIs, or do we keep the data within the MAGNiTT platform? And more important than anything else, actually, that I've now only through this conversation and many that I've had in the last 2 to 3 weeks, you can get data, but who's telling you the story behind the headlines, right? I very much, especially in the last 3 weeks of conversations that I've had with governments, fund of funds, VCs, the data tells you one thing, but the reality is the insights that you're picking up that are subjective are not part of the data. And you can make wrong assumptions based on data at a high level than understanding the insights from them. Now that's consulting, that's a different type of, but if you look at the wrong data, you'll get a wrong output. And I think that's one of the biggest risks that's happening right now. If you're not asking the right questions and you're not looking at the data in the right way, you will get the wrong answer coming out of it. That becomes part of the problem with all of these AI solutions. Now it's a question of how you build the relationships with them for it to be kind of constructive and accurate.
And that's why Bloomberg is Bloomberg, right? Because it gives you the most complex level of data, but also the story and the insight and the headline and all of that.
And that's why, and again, we've cut back a lot of research, right? Because we've understood that a lot of it just gets fed into different types of machines. But if you're a client of MAGNiTT, you'll get a lot more intelligence on the subjectivity and the information, and we will give you the answers that you're looking for. The hard part is, and I'll be honest, a lot of people don't know the question that they want to get the answer for. So sometimes you have to support them and work with them to identify that problem. So I give you an example. In the midst of the war, we came out with a report. Here are 5 pressure points, learning from COVID, that you need to be looking at. Nobody was talking about what was like happening or what, but we tried to come out with a very clear framework that we built as integrated dashboards. If you're in Saudi, if you're in the UAE, if you're in the GCC, if you're in Egypt, here are the things that you need to be looking at for the next 6 months. And that conversation is not had in the public domain. Some people might be having it privately, but like, how can you structure the thought process to build out the data from that perspective? And that's why we're very dear. It's not about the total funding and the total number of transactions. That makes for great PR and it'll go into a newspaper. It's the underlying beyond the headlines that actually is very difficult to get through these type of solutions.
Is there a MAGNiTT chatbot that people can chat with and ask these questions
We
to?
are literally developing different AI solutions. We don't have a chatbot yet. It's something that we're looking to see whether that's going to be a game changer. We're trying to develop whether it's the MCP or the dedicated solutions on MAGNiTT that makes the most sense. And it's not just us. Every global player has the same issue. Even Bloomberg came out with a chatbot because they think that that's going to solve the problem. But the question is, I don't know that people are actually using it. So it's interesting to see what people rely on from a data perspective. And there's a huge conversation. So if people have feedback and what they would like to have, please reach out to me. I'm very happy to speak to either prospects or clients on what their problem is. But what you realize is that the problem you're now solving for is ease of solving a problem. It's no longer the data. It's just, I want it to be quick and instant. And that's a new problem that we're trying to solve for.
Philip, you've been running this for like 10, 11 years now, and we have two, like, let's say, schools and sets of founders in the region, right? We have people who just treat the company as their baby. They keep kind of running with it no matter what happens. Kareem, it's the initial sale, and then Ian coming in, and then a re-acquisition again and again. You have Mustafa, the founder of Swivel. He's just run with it no matter. You have 11, you've been doing it for 10, 11 years. And then you have people who take a much more commercial approach to things. So again, we talked about Abdullah, the founder of Mal. It's from kind of before that Astra, before that Rizzi, etc. In Swivel itself, our second co-founder, Sabah, he kind of moved on, the Telda, etc. So how do you see these two sets of founders from your data, from your perspective? What drives you personally to take the first approach?
Well, I mean, MAGNiTT as a business is not necessarily a venture capital business. We did an investment round, but I think you think it's very different. We looked at all of our global competitors, and it's data as a business has huge amount of value, but it's not kind of that type of scalable business that you're looking like e-commerce and fintech and etc. So for us, we're very much focused on unit economics and growing to build towards ultimately potentially supporting a global player that is looking to kind of develop into the region. And to the point that we were mentioning before, one of the things that AI helps you with, you can definitely do a hell of a lot more now than you ever did before, whether it's cleaning the data, gathering the data, proxies around the data. So it becomes an enabler for many companies who are looking to set up now for the purpose of either a sale or IPO. From that perspective, I think the data is very interesting. You're beginning to see the evolution of many second-time founders. Obviously, it takes time to become a second-time founder. And after 10 years or 11 years of using MAGNiTT and tracking the data in the ecosystem, the emergence of your Tomasos and others who are now building second and third-time businesses is interesting. I think the more interesting dynamic is what are they building and where they're building it for. A lot more people are having a global mindset in the way that they're building their businesses compared to what was before. Again, we talk about the souks and the Kareems. It was MENA, every country in MENA. We want to be in 15 countries in MENA. Now, there's a lot more learning lessons from the VC side and the founder side on having to think global, but it's not exactly obvious how you operate in the States out of the Middle East. You're either operating in the States or you're in the Middle East. So you're also seeing some people relocating to the States because they've now understood how difficult it is to build a company here in the region and therefore need to go elsewhere to be able to kind of do the second venture. So I think you're now seeing that. I think both founders and VCs are becoming a lot more attuned to commercials and the need for exits. And therefore, that's maybe one of the reasons that they are more critical of the deal flow that is coming in and the importance of scale It's why people are really embracing AI as the solutions, because they believe that those are the most globally scalable solutions versus some of the others. But I think that across the board, you're seeing founders, specifically those that are second and third times founders, thinking global, working with governments to solve for big problems and solutions, and raising capital, as you already mentioned, from alternative asset classes that can support them in achieving that objective. Those that are commercially minded will definitely be focused from that exit perspective. But I think that the exit challenge needs to be addressed to see more of that liquidity come back to the market.
Do you think there is a risk that may seem like it is very positive because we're now building more global outcomes as opposed to regional outcomes? What ends up in reality is a brain drain where these founders end up leaving, building from outside, like we've seen with Clay, with Replit, etc. And then do we stand to benefit because reputation now people believe more in the region, or do we stand to lose because effectively that best talent has now left?
I don't think that there's anything wrong. I think it's great to see these founders from the region changing the story. I mean, Kalshi, you got Replit, Clay, you got many of these, but I don't know that they came back to, I don't know their individual stories. I don't know that they came back to this region and went back. Many of them were in the US. But I think it's great if it inspires the next generation of founders from the region. That's absolutely great. And let's be clear, from a geographical perspective, if you believe in developing into the region, you will ultimately still need to build local teams. It's why everyone is obsessed with like the regional headquarter. I mean, even if you're a global, if you're Calcia, if you're Replit, and you need to come to the region, you still need to have a regional team to operate in the region. Revolut has a local team. Carter has a local team. They still need to hire people locally. And so you either acquire and or develop locally. So I think it's great to see global players that are from Middle Eastern diaspora going. I don't think you're competing in the same type of space, but in the end, everyone wins and everyone gets inspired. And then you have the next evolution. The challenge that we're trying to solve for is how can you build global companies from the region? I think that's the problem. It's not about, you're not competing with the ones that are abroad. You're competing with how can you develop and build global companies from the region. That's the problem statement.
Philip, you come from a consulting background into a founder. What is the data telling you about what are the most successful backgrounds? Because there's a lot of like stereotypes and myths, right? There is, for example, is kind of younger, more energy, kind of more all in versus older founders, more mature, have more experience. Came from other operatorship roles where they're more hands in, or came directly from consulting or banking, they're more transactional. Founders who maybe came from less privileged backgrounds, who are more hungry versus founders who came from actually more privileged backgrounds. Actually, maybe they're more comfortable. They're willing to give it a longer runway without having to quit. What is the data telling you? What is the background, demographic backdrop of the founder who is more likely to be successful?
Look, this is a great question. And again, these are the type of research pieces that we love to do, but then we need someone to support us in doing it. We did this for Saudi 3 years ago with SVC. We looked at the regional, and I did one of the first reports that we did was called the Founders Report. Ali Tamasab has brought out a book on kind of the breakdown of founders. What you see in the data, and it's 2-3 years old, is that the average age of a founder that has successfully raised capital tends to be in their early 30s. They're not in their 20s. Some are even more successful when they get to their late 30s and 40s, but the average age was about 32. Serial entrepreneurs make for the best entrepreneurs and are easier to invest in. And we're now seeing that probably more and more so. On the technical side, a larger percentage are non-technical founders in the region, because in the end, you end up solving pain points that you discovered in your professional career. So when you look at and it's now a bit antiquated and I'd love to update it, but if you look at your Kareems and you look at your Souks and you look at your Kitopis and you look at those people, they've all come from their industries to solve problems, whether they were in consulting, whether they were in banking, whether they were in logistics, whether they were in food and beverage. And therefore, many of them have come from the professional services that they were in. The founders tend to be non-technical and acquire a technical founder or a technical early employee to support them in the journey. But the problem that they're solving for, I often say, like, consultants have proven to be some of the most successful founders because they sell a story. Something I'm quite passionate about that the region is probably needs to continue to develop and improve is selling stories. Consultants by trade have to learn how to tell a story to a client. Pitch decks, speaking confidently, being eloquent, problem solution orientated, always coming up with the next steps, follow-up emails, communication by email. All of those skill sets are very important when you're raising funds, and therefore consultants, investment bankers, people who've been in management within certain industries prove to be the ones that are successful in being able to raise funds. And we even had a chart in that, like which consulting firms had the most. McKinsey, BCG, Oliver Wyman have historically always had founders that come from that industry. Your tech founders, because we don't have the research and development, we don't have the investment from the university levels, they exist, but to the level that you have in the US and Europe, they need help. They need a business partner. And who's the business partner to map, to kind of connect with the technology founder isn't something that we see as prevalent. Doesn't mean that it doesn't exist. But your first time founder coming out of university, engineering with a prototype, MVP, because of the costs associated with setting up. Now, again, Egypt, Lebanon, Jordan, cheaper, which is why some of those technical companies start from those jurisdictions. When they need to raise funds, need a business person to then go and raise funds from the GCC. I mean, that's what you see as the trajectory. UAE, a lot more business people that then have to try and find the technical talent and outsource it. It's not uncommon. I started that way. You're a professional founder. From a business perspective, you use an outsourcing service, and then you have to get the CTO to come and join you as you raise your funds. That's some of the things that you see here. But your technical first-time founder are a lot fewer and far between than business people, specifically coming from the GCC.
Philip, you gave us a wealth of data today. Someone who's listened to our podcast, who's kind of read your report, maybe give us for a founder, a GP, an LP, and a policymaker, what's the one key takeaway you want them to take from this data for each one of the four?
Policymaker, it's in a crisis that you need to invest. It would be a huge shame right now if policymakers don't double down in the ecosystem when it needs the most capital. If we have a problem with international investors and people coming to the region and companies looking to scale, now is the time to double down. And each of them need to look at how they can get that capital with all the competition of capital that exists. LPs, data is king. Performance metrics are important. Understanding and gathering that data will be key to see which GPs need further deployment of capital. But with the spirit of the first one, the policymakers' role isn't necessarily to deploy capital, it's to find the pools of capital to deploy. How can the LPs sell the story and help shape the story for other people, including government entities and corporates, to be encouraged to participate into this space? VCs, don't delay, please. If you have conversations, whether it's a yes or a no, don't delay decision making. The region really needs to improve quick decision making and behavior so that people can get to an answer and move on. And this is something that has always been shared. I think it was part of the post that was shared. Quick decision making. A decision is better than no decision. Whether it's yes or no, come up with an answer. And I say the same thing. You didn't ask me this question. If you're a vendor and you're a supplier and you're a corporate, don't delay payments. If there's one thing that you can do to support founders at this point in time, pay on time with transparency. Nothing kills companies than cash flow. And during this time, being able to be transparent on payments is more powerful than any funding. Revenue drives a story. Killing that revenue is the biggest challenge. And for founders, I don't like to give advice to founders, but for founders, it is a challenging time. Build your story. And I'll leave one point, and a few founders I speak to who are colleagues of mine or at least peers of mine, you are all sitting on a wealth of data. Nothing is more powerful than content marketing. MAGNiTT started its first ever reports when Payfort started doing the state of payments in the Middle East, where they took all of the data of their customers and started talking about trends in the financial services. They were clean, they were simple, they were graphic, If you are looking for SEO optimization, AI for what it's worth, optimization for being referenced, if you're in leisure, if you're in podcasting, if you're in what are the trends that you are seeing that your customers are doing, you are sitting on a wealth of data, share it. Leads will come from content marketing, and it's an undervalued tool of storytelling that I think that the region needs to continue to develop because it's extremely powerful to sell your story. That's the one piece of advice that I have in the current environment.
And you've told us an incredible story today. Thank you so much for being with us.
Thank you very much for having me, and congrats on the podcast.
Thank you so much.
Thank you.
Thank you.